Welcome to this video. Thanks for joining me. So in this one, I'll be covering the status of bonds at this point in our investment portfolio. As we know, bonds have been making the news lately, and that is all because of the fact that they are becoming much more valuable, at least to investors. And there is a reason for that. I'll be covering that in this video. If you're new here, my name is Steven, and on this channel we'll talk about finance and investing. So if you're interested in that, please consider subscribing to the channel. If you are thinking of building your wealth and building your portfolio, there's always the mixture of investments that you can bring together. You can always have stocks, you can always have some cash, and of course we then have bonds. Now, if you are not familiar with what bonds are, like I said, I'll link a video below, but I'm just going to give you a very short description of what a bond is in this video. So you can think of a bond as a type of loan, but in this case you are the issuer of that loan. You are giving out that loan to maybe a corporation, maybe to the government, or maybe to municipals and so forth. And when you give them this money, they'll promise to pay you back that amount, but also they promise to also pay you some interest, which comes in as coupons over the course of the year. Sometimes they pay twice a year. When you think about that, it makes sense for someone that has a lot of cash that wants to preserve their money to give it to reputable companies, reputable government entities, so that they can always take some money or income from the money that they loan out, these coupons that comes in regularly. Now, a lot of retirees would always count on these coupons as a form of income, which is why bonds are generally termed fixed income assets or investment. Now, bonds come in different types. They all can be from the government, like I mentioned. They can be from corporations, like from Apple, Microsoft, and so forth. And we also have some that would come from municipals, like your local government bodies. And all this would generally come at different rates or yields. Now, of course, if you are thinking of finding the bond with the most yield, you also understand that that comes with a risk. Just like any type of investment, there's always risk involved. So if you think of getting a bond with the most yield, you also have to understand that there's a reason for that. And that is always because if you think about this, you're trying to lend money to someone that has a chance of default or not paying you back, then you generally want to command a higher yield so that you're taking on the risk. You want that risk to be built into the money, and when you make your returns, you want to see that back. But bonds are generally very low yielding type of assets, in a sense. They will generally fluctuate between 3%, 4%, 5%, and so forth. You hardly would see a bond that will pay you up to 6 or 7%. Now, there are some, like the I bonds that we know, that we heard of last year that everybody was trying to get into. There are some exceptions like that, okay? But generally, bonds from corporations will range between 3, 4%, and 5%, depending on the situation. So what has been going on lately is this. Last year, due to the fact that inflation is skyrocketing, the Fed started to step in to combat inflation. And what do? They increase interest rates. Now, the reason why they would do that is by increasing those rates, they can actually help to cool off the economy and slow things down so that people are not spending and buying things that they don't need pretty much. So by doing that, they end up slowing down the economy, and inflation goes back down to the average that they're looking for, which is around 2%. Unfortunately, because of the fast-paced rate increase that we experienced last year, the bonds started losing a lot of value. Why is that? And this is the important part of this video. So if you think about this, right, when a corporation issues out their bond to be sold, okay, and they need that money, they're writing out a request for this loan, which is the bond that is being issued. We go in as investors and say, okay, well, based on the current market, based on the current trend in the industry, and based on the current interest rates that I'm getting on my savings and the rates that I can get in the stock market, which comes with a lot of more risk, right? I would take, let's say, this 3% bond yield for the next, let's say it's a 1-year bond, or let's say it's an intermediate bond of maybe 3 to 5 years. Now, that rate that is being issued to that bond is kind of stuck with it for its lifetime. Now, there are some bonds that are callable, that the rates can change, but we won't get to all of that in this video. But for this example, a bond, let's say, give you an example. Let's say it's $100 worth and you have that $100 to lend to this company. The company said they will pay you, let's say 5% back after 1 year. They will pay you $2.50 maybe after 6 months, and they'll pay you $2.50 after the end of that duration of the bond, and they'll return your $100 to you. So that means at the end of this whole transaction or this investment, you should be getting back about $105, right? At that 5% that they promised you. But let's now say that the next day that this bond has been issued, or maybe a week later, or maybe a month later, that you're already waiting to collect $2.50 on this 5% bond. Let's say interest rate goes down. Okay, because of the decreased interest rates, let's say interest rates on an average is now 4%. You see what has now happened to your bond. Your bond has now become more valuable because your bond is paying you for the next maybe 11 months. It's going to pay you 5% plus the face value plus the amount that you lent out. So now your bond has become more valuable, which means if you were to sell that bond to someone else, that person should pay you a bit more for your bond, because in this case you were supposed to get 105, correct, at the end of that bond, and any bond that is being issued after yours is only going to pay 104. So yours is more valuable, hence the price of your bond tends to go up. So that means somebody will have to pay you more to buy it from you. Now, if you choose to not sell it, at the end of that 1 year, you get your 105 and you have. On the other side of things, let's assume that interest rate goes higher. In this case, from 5% on an average goes to, let's say, 6%. Now, your bond has become less valuable because, well, a month after yours that is being issued at 5%, now new bonds are now being issued at 6%. So what will happen to your bond is it becomes less valuable. People will not want to buy it, hence causing the value to drop, because why should I buy something that'll pay me 105 when I can find something that'll pay me 106? I hope that makes sense. There's a lot more to it. As you can see from this explanation, this short explanation, you notice that the main risk when it comes to bonds outside of default is also the interest rate risk, which means the fluctuations of interest rates over time could affect the value of your bond, and that is exactly what has been going on. So interest rate has gone up. Bonds that were issued, bond holders that already had the bonds, lost value, which was why bonds also lost a lot of value last year. If you check a lot of bond funds, you notice that they lost a lot of value last year. But something interesting is happening now, because the interest rates are now going higher. The bonds that are being issued now are commanding higher rates. So that means that if you can buy a bond now for the next, let's say, 6 to 9 months or maybe a year, chances are you fare well, or you fare better than people that bought their bonds a year ago and actually have bought a bond like 2 years ago, and I'm actually losing in that position. So what should you be thinking of at this point? Well, my advice, I'm not a financial advisor, by the way, but just as my own, I won't say recommendation, but what I would think is look at your portfolio, see what you think is best for you. To be honest, there are so many other assets right now that are paying close to 4-5%, like CDs, which I'll be covering that in another video. So of course, if you haven't subscribed yet, don't forget to subscribe. And also, if you haven't dropped a like, please, it's free. Go ahead and drop a like on this video. So there are so many other assets that comes with less risk compared to the stock market that has been falling like a rock, but also bonds is an option. So if you haven't invested in bonds, you should consider maybe investing in that and hopefully be able to make some money over the course of time without risking your portfolio to a lot of volatility and maybe a decline. I hope this all makes sense. If you haven't checked out my video on what bonds are, you can check it out here.